While examining the income statement, we already became acquainted with one type of ratio, earnings per share. Remember that earnings per share equal net earnings divided by the number of outstanding common stock shares. When calculating the number of shares, one takes the total number of shares issued minus those bought back by the company. Those bought back are referred to as treasury stock. We know that companies issue not only common stock, but also derivatives and convertible securities, such as warrants, rights, convertible bonds, and convertible preferred stocks. If we calculate earnings not only per share of common stock, but also for all the convertible and derivative papers, we get a result called fully diluted earnings per share. Now, traditional fundamental analysis holds that if during a significant period of time a company shows a consistent increase in EPS, there is stability in the growth in the general financial situation of that company. However, you should note that the equation shows us that the growth in EPS can be attributed not only to the increase in profit, but also to the decrease in the total number of shares. The reduction in the number of shares can occur for different reasons. For example, if the company begins to increase its level of treasury stock. No less care should be given in the event that there are negative changes in the EPS. This does not always indicate a decrease in profit, as it could be due to an increase in the number of common stock shares, which could result from the issuance of additional shares, splitting, the conversions of bonds, etc. How then is it possible for a beginning investor to find the true message that the EPS carries? In this case, it is possible to trust the professionals and to respect the comments made by various analysts. As a rule, in these commentaries, the reasons are specified as to why there was a change in the EPS. Finally, it is important for the trader to realize that today, the American markets are experiencing a boom in the number of individual investors. Not being professional traders, nor having much free time, they almost completely rely on commentaries about the market situation, which are given by well-known market analysts and distributed in the mass media. As a result, the short-term ups and downs of stock prices are related not to the EPS, but to the conformity between EPS and the evaluations given by analysts. We can notice such effects daily. A company issues a benign quarterly report. The change in the EPS is positive, and the profit, as compared with the last year, testifies to growth. However, given such a bright picture, the share prices start falling. Why? Well, it's due to the fact that a report on expected EPS was made public by some influential analysts, which called for a greater EPS than was finally released. Thus, these are the unjustified expectations resulting in the decrease in the stock's price. It may be concluded that it is always important to take into account the EPS and its expected value. Now, there are other ratios similar to EPS. One is sales per share, which equals the total sales divided by the number of outstanding common stock shares. And another is dividend per share, which equals the size of the dividend divided by the number of outstanding common stock shares. Another important group of ratios deals with the current market price of securities. They are the price-earnings ratio, which equals the current market price of the stock divided by earnings per share, the earnings yield, which equals earnings per share divided by the current market price of the stock, dividend yield, which equals the dividend per share divided by current market price of the stock, and price to book value, which equals current market price of the stock divided by book value per share. The price-earnings ratio is one of the key concepts of fundamental analysis. It shows how much the current price is bigger than the company's income. For example, if the price-earnings ratio for a given company is 30, this means that its current market price per share is 30 times greater than its annual earnings. It's necessary to distinguish two types of price-earnings ratios. The first type is a calculation of the annual EPS from the prior fiscal year. This is called a trailing PE ratio. The second type is called a forward PE ratio. In this, the amount of earnings from the 2 previous fiscal quarters is added together with the estimated earnings for the 2 next quarters. The P/E ratio is very convenient for detecting the bulls or bears behind the stock. The higher the P/E ratio, the more overvalued the stock. This means investors' expectations regarding the given stock are high. The question is, what to do with overvalued stocks? Well, the best approach is to consider the P/E ratio as a measure of the risk associated with an investment. In other words, the higher the P/E ratio, the greater the risk. On the other hand, a low P/E ratio can be dangerous as well. At first glance, a stock with a low P/E might look attractive, but a low P/E might be an indicator of a lack of interest on behalf of investors. A P/E ratio is considered high when it is above 20, low when it is below 10, and average when it is between 10 and 20. The earnings yield and dividend yield are important for the investors that purchase securities of solid companies and want to gain their profit via the dividends rather than by capital growth. The companies with rather high earnings and dividend yields are the most attractive for this type of investor. The price-to-book value plays an important role in detecting undervalued securities. As a rule, this ratio is greater than 1 because the market value of stock is regularly higher than its real value. This is natural due to the fact that the market price should reflect not only the real income, but the expected income as well. It is possible that from time to time, the price-to-book value of a stock can become unjustifiably low due to some price disproportion. In such a case, this stock would be considered as a candidate for purchase. Credit ratios help investors to determine whether a company can meet its liabilities. The major credit ratios are the current ratio, which equals the current assets divided by current liabilities, quick ratio, which equals current assets minus inventory divided by current liabilities, and the cash ratio, which equals cash and cash equivalents divided by current liabilities. Each company must meet their liabilities, such as tax deductions, wages, accounts payable, interest payments, etc. For such payments, the current assets are used. Current assets are those which can be converted into cash in a short period of time. Thus, the greater the current ratio of a company, the better. At the same time, we should remember that the current ratio varies from market sector to market sector and depends on the speed of the capital turnaround. Naturally, the utility companies, which receive regular and numerous payments from their clients, can live with a low current ratio. At the same time, automotive companies, whose production cycle is extended, must maintain a high current ratio. Now remember, the current assets are constituted of several components, such as cash and cash equivalents, short-term investments, trading assets, accounts receivable, and inventories. Now let's assume that a company must urgently make payments to meet their liabilities. The simplest way is to use cash. A more difficult approach would be to sell trading assets, or accounts receivable, in the market, and then use the cash generated from these sales. Finally, the company can go through the entire production cycle, use inventories for the manufacture and sale of products. Now all this should lead us to the conclusion that in order to get a clear picture of a company's ability to meet its liabilities, only certain components of the current assets should be considered. For this purpose, there exist 2 other credit ratios, quick and cash. When calculating the quick ratio, we deduct inventories from the current assets, and when calculating the cash ratio, we take only one component of the current assets, such as cash and cash equivalents. In conclusion, there is one important principle to note when applying these ratios. The most productive way to use ratios is for the comparison of various companies which belong to the same market sector. This is due to the fact that the various market sectors have their own range and level of ratios. It's useless to compare the P/E ratio of a bank, for example, Wells Fargo, and an internet company, such as Yahoo, because they exist in two different market sectors. The P/E ratio of Wells Fargo is much lower than that of Yahoo, but this doesn't mean that Wells Fargo is undervalued. Companies in the banking sector always have a lower P/E ratio than companies in the high-tech sector. Thus, it's useless to make a P/E ratio comparison between these two groups. Now, the term market sector relates to a group of securities dealing with one particular field of business. There are various ways to classify securities when talking about market sectors. We're going to look at one of the standard systems. We start off with basic materials, and you can see what's included in each of these. The next is capital goods, conglomerates and consumer cyclical, consumer and non-cyclical, energy, financial, healthcare, services, technology, transportation, and finally utilities.